Hello and welcome to another weekly update. My name is Grant Collins. I'm an independent economist with AIM Research. And in today's weekly update, we're going to cover everything that came out last week and give you a primer for what to expect for this week. It's a holiday week, so it's shortened. We don't have a lot of data coming out this week, thanks to the Juneteenth holiday. But also it was Father's Day weekend. So for all those fathers out there, I hope you had a great day. And we thank you for all that you do. So in this weekly update, what we're going to spend some time on is talking about the inflation data. The Fed also met this week and decided to leave policy rates unchanged. So we'll talk a little bit about that and how the market is interpreting that. We're going to close with looking at industrial production, retail sales data, as we got a lot of information from those, as well as Fed survey data out of New York and Philadelphia. So a lot to cover. Hopefully we can keep it within our 30-minute time frame. Let me go ahead and start by sharing my screen here so we can get started. So we started the week on CPI data. It did come down. It came in better than expected. Just to give you a recap here, headline CPI was projected to come in at 4.1%, ended up coming in right in line with that. The prior month, however, was 4.9%. So it did come down quite a bit. You're seeing it now at 4.129. So a straight line down that really shows a lot of progress that has taken place on the headline number. Core, however, looks a little bit stickier. It was 5.5% prior. It's now 5.3%. That's exactly what analyst expectations or economist expectations were. They were expecting it to continue to come in at 5.3, and you can kind of see this stalling here as we kind of hold and hover close to 6%. Now, what seems to be interesting is services and shelter continue to play an outside factor in keeping inflation elevated here. In fact, I have on the screen here that if you remove shelter, that CPI has actually come down to 2.2%. The reason why we remove shelter is there's alternative measures than the one that the BLS uses. Alternative measures like the Zillow rent estimate, which has been coming down month over month for some time now. It hasn't really showed up in the quote unquote shelter side of the services. I'm getting tongue tied here with all these S's. But it hasn't showed up yet, but hopefully it will. This is kind of my take on why I do feel like we are going to get back to that 2% target. And for those of you that looked at our forecasted estimate prior, we expect inflation to be closer near 3% by the end of the year. So we're still seeing a lot of progress being made here. That's where I think I differ a little bit from Jerome Powell. Jerome Powell is looking at shelter and he's looking at services and saying, look, this still looks to be an issue here. And so they want to continue to move forward here. And we're going to touch base on that in just a second. Here's the shelter component, which is up 8.3% year over year. It's in blue. You can barely see it coming down, where you see a lot of progress being made in the fuel, in the food, and the energy. Energy dropping down to only up 1.6% year over year. So energy inflation is basically out of here, where food inflation continues to be sticky but coming down. Here's services versus goods. Durable goods and non-durable goods have been coming down for some time, where services, again, services and shelter being those two components that Jerome Powell is concerned about, holding at 6.3%. Now, it's important for you to think about that because we got the CPI report and we got the PPI report going into the Fed meeting. The PPI report came in better than expected, coming in at 1.1%, where the forecasted estimate was for 1.5%. The prior month was for 2.3%. So the producers price index continuing to slow down at a much faster pace. That really matches what we've been seeing out of Fed survey data and continues to, in my mind, show us that inflation ultimately will be labeled as transitory. Now, transitory doesn't mean a matter of months. It looks like it's now going to mean a matter of a year or a year and a half, but I think ultimately the Fed will be right in that decision and that call. Where I think they went wrong was just raising rates too slowly. They're now on the path, and I love Jerome Powell's language in his press release. So when he came out and he started taking questions, they were asking him to really assess, if your projections say that you're going to continue to raise rates, but you're pausing at this meeting, talk to us about why. he basically said, look, there's three ways of looking at this. There's one, the speed at which you need to raise rates, two, the level that rates need to be at, and then three, time, how long or the duration do they need to remain in a restrictive level. You don't need me to harp on this, but I've been mentioning that rates are already restrictive, and they've been restrictive for some time based on senior loan officer survey data, based on the housing market being in recession as it's very interest rate sensitive, be it the banking sector and the bank failures that have come along the way. So those are signs that the restrictive policy is taking hold here. But I think what's different and what's interesting is the way that Jerome Powell labeled it. So the speed, they went very fast in 2022. The level, they believe they're restrictive now, but they're just not sure how restrictive they actually are. And the time, they're not quite sure how long they need to leave rates restrictive. In their summary of economic projections, they gave us a little bit of that information. You can see here the federal funds rate projections. You're seeing 5.6% in the June and 4.6%. So they're looking for a reduction of 1% over the next calendar year. What's interesting, though, is for 2023, they don't see rate cuts at all. They're expecting a 0.5% increase for this calendar year. That's interesting when you try to square it with the fact that they decided to skip this meeting. Skipping this meeting, but yet still putting in the projections that you need another 0.5%, kind of left market participants on their heels a little bit. They weren't quite sure how to digest it. I think originally when you look at the week as a whole and you look at the market as a whole, the market continued to drive higher here. So the market, I think overall the reaction was positive. But again, I don't think they quite understand the fact that even though the stock market likes it, the bond market didn't like it. You started to see some repricing in the bond market, and I want to show you that here. You can see it in the Fed funds graph as the 1 year has come down dramatically to stay within that 5.25 range. So you're looking at this range right here. And then the 2 year has come up quite a bit, trying to reach that same level as well. So we're kind of converging in the short run here and in the short 1 month and 2 year paper and trying to get back into that Fed funds band. The 2 years, your leading indicator, that's what the market thinks the Fed's going to be doing. And so the 2 year is probably going to hover right around this 4.6. I think the 2 year will anchor on this expectations of rate cuts, even though I expect interest rates to remain the same all throughout this calendar year. I expect basically, barring any shocks, that we remain at 5%. Because what other shocks have we had? I mean, there's geopolitical shocks that could still occur, maybe with tensions with China heating up. But the banking system is the only shock that we've had so far this year. Company earnings have come in negative, but they've come in better than expected. And so we're going to have to wait for, the next quarter here, which is reported to be negative as well. But if it comes in better than expected, the only shock that you're going to have is coming from the banking sector. And if we come down here and look at the banking sector, borrowing from the Fed has come down. It peaked just below $300 billion during the banking crisis. I'm going to put air quotes, the mini banking crisis with Silicon Valley Bank and with First Republic Bank. What we've been seeing is borrowing from the Fed has come down, even though the Bank Term Funding Program has accelerated. This is weekly data, and this is weekly data. I'm using total borrowing, which also includes this Bank Term Funding Program inside of it, and you can see that that's been coming down as well. So to me, again, this is kind of showing signs that maybe that banking crisis is coming under control, and that the increase in interest rates here that they're reflecting may not necessarily be necessary, that if they do much more from here, they're tightening the screws on the economy more than I think is necessary. They're already restrictive. They're already seeing progress made. In my opinion, they should just continue to hold here and allow balance sheet to run off in the background and be that tightening that can still happen on the economy at a much more slower pace. To me, that makes the most sense. Now, you do have the Treasury General account that's trying to rebuild here, but to me, it doesn't look like it's affecting reserves that much. You can see that the TGA is just over a touch of $100 billion, and you can see a small building taking place. And it looks like all of that's coming from the reverse repurchase agreement market, or the repo market. That's been coming down right as we're starting to rebuild this. And you're seeing a small hook downward here in reserves, but not a lot. So, it's unclear whether it's going to come from reserves or if it's going to come from the repo market. Depending on where it comes from, will, I think, and could have an impact. But right now, as the Treasury rebuilds, it seems to me that there's still a lot of reserves left in the system, that they can pause the rate hikes and continue to allow quantitative tightening to work off in the background. And that'll be enough tightening to keep bringing that inflation rate lower. I think that's so important. I think the market may be missing that element, that there is a path to maybe avoiding a recession. There is a path that maybe the unemployment rate remains low post-COVID because the labor force participation rate is so low. It's because we haven't had so many people return back to work. All of those factors can lead to this economic malaise, so to speak, where the economy just grows below trend and grows at a very, very sluggish pace, barring a shock. And I think a shock is still out there. It can still happen. And when you grow below trend and you get that shock, it can tip you over into a recession as businesses and consumers try to react to that shock. So I definitely found the summary of economic projections as a key headline to note. The pause itself wasn't that much, in my opinion. I don't think the pause was really the news. It was the summary of economics projections that were the news. It was the fact that they raised their forecast for growth, going from 0.5% to 1%. They lowered their unemployment rate from 4.5% to 4.1%, and they increased the federal funds rate by 0.5%. So they're expecting still some economic growth, and so they're going to continue tightening for the rest of the year, or at least that's their base case at this point. So that's what you got at the beginning of the week. The beginning of the week, you got the inflation report, you got the Fed minutes, and you got the Fed interest rate decision. You move into the later part of the week, and you got you got the manufacturing survey data from both Philadelphia and New York. You got retail sales data, and you got industrial production. Let's hit on these one at a time. The regional Fed survey data is from New York and Philadelphia. Let's hit New York first. These both, first and foremost, continue to give you different conflicting views. New York showed a sign of recovery. In fact, New York on the General Business Conditions Index declined 31.8% on the prior month, but accelerated up 6.6% in this current release here. And you can see that kind of bottoming process taking place here in New York. It's not only in general business activity, but it's in the new orders report as well, as that increased from -28 to 3.1. And so again, you're seeing this kind of bottoming taking place in the manufacturing sector. Current employment and prices paid in New York continued to come down. So it's a positive sign for inflation as well, where employment just kind of moved sideways here. So not much change out of New York. Now, contrast that with Philadelphia. Philadelphia gave us a completely different reading. You can see that Philadelphia actually rolled over a little bit again after recovering. So Philadelphia on a general business activity index came in at -13.7. That's lower than the prior month at -10.4. New orders also declined, coming down to -11. That's lower than the -8.9 from the prior month. So new orders fell, again, completely different than New York. Employment held steady, so not much change there. And then prices paid held steady, so not much change there. So employment and prices remain the same out of both New York and Philadelphia, where general business activity look and reflect a little bit differently. So maybe there's a sign here where you're just kind of trending sideways here, and the big decline in manufacturing has already happened. To me, that's consistent with the decline that you're seeing in GDP and this leveling off here. Remember, my viewpoint is that as demand slows down, it's going to bring inflation down. As inflation brings down, you're going to get this reacceleration of demand at some point. Is this that point? I'm not sure yet. We're going to have to continue to see how prices continue to shake out and how demand continues to pick up. But at least on the manufacturing side, you saw improvement from New York, and yet some still falling here in Philadelphia. The bright spot of this week, in my opinion, was retail sales. Retail sales data did come in better than consensus forecasted. So economists were thinking that retail sales was actually going to come in at minus 0.1% month over month. It actually came in at positive 0.3% month over month. Very narrow, though, as far as what did very well. And you're going to see it here when we dig into the report. The two things that stuck out were autos, so motor vehicles and parts, and then building materials did extremely well. Let's look down here for just a quick second. You can see retail sales here kind of flatlining, moving sideways, definitely below trend. And you can see that from a cycle perspective. Let's come down and look at that motor vehicles and parts. So when you look into the individual side, this is a really big driver. In fact, if I can come down here for just a second to read you the headline number, motor vehicle sales were up 1.4% month over month. That's a really strong report, and you can see a strong upward trend, even though it is gyrating a little bit here. It consolidated in this little range and looks like it's starting to break out again. Again, you can see how it's moving back into line with trend. And this is just one bright spot. The second bright spot of the report, if you come down a little bit further, was building materials. And you can see this little hookup here. Again, it was trending sideways and started trending down, but now you got a really good report here. It's still well below trend. So even though you have this 2.2% increase in building materials for the month, it's still not enough to move it back above to trend or through trend. So retail sales, to me, on a cyclical perspective, still looks like it's slowing down, especially when you take out motor vehicles and parts. It really looks like it's struggling and looks recessionary if you remove the auto industry. But as you're going to see on the industrial production numbers, motor vehicle manufacturing is the bright spot in this report as well. So, you're seeing motor vehicles and parts sales pick up. You're seeing particular manufacturing pick up. And so that seems to be a bright spot right now in the economy. Let's look at industrial production. Industrial production actually came down 0.2% month over month. That was slightly lower than forecasted. What we are seeing, though, is motor vehicle and parts continue to show strength while energy and utilities declined. Utilities were down 1.8% month over month, while energy was down 0.7% month over month. So if we just look at industrial production in general, it's basically hovering right at trend. Yes, it's kind of slowing down here. That's in line with the general slowdown that's taking place of all of the coincident indicators, such as incomes, consumption, and industrial production. But again, there's pockets of bright spots. And so that's what I think we have to be cognizant of. It's not a widespread decline, which is where everybody would be calling for a recession. It's more of, hey, we're declining in this sector, but not in this sector. And I think that's important to note here as well. Let's come down. Here's manufacturing. Again, holding pretty close to trend there. Here's mining. Mining actually looks like it's been accelerating for some time here. Looks like just briefly on a month over month slowing down relative to trend. Here's those utilities, and you can see that that's pretty well flatlined and has come down. Again, in this report specifically, down 1.8% month over month. You can see that it's really far below trend, 105 versus 102. Here's that motor vehicles and parts really accelerating to the upside here, 112 versus 105. And again, that squares really well with the retail sales data. You're seeing demand in that space, so that's why there's a lot of manufacturing taking place. Here's the energy, basically right in line with trend, just slightly below it, but you can definitely see this hook Again, going back to the inflation data, we've seen energy inflation coming down a lot. And so production of energy is coming down as well. It's a big reason why OPEC is cutting production. The demand for energy has slowed down. And so they're trying to cut production here. One more thing on industrial production, looking at the technology sector, everybody's talking about this artificial intelligence boom. So we're looking at industrial production in semiconductors and communication and in computers. You can see that the trend is directionally upward, and it has been that way for the last decade. But from a cyclical perspective, it has rolled over hard and looks a lot like the GDP data, or from general, and some of the other slowdowns that have taken place as inflation took hold. But again, you are seeing a slight acceleration here over the last little bit, as again, everybody's jumping into this artificial intelligence craze. So we are going to be watching that. I'm going to be keeping a close eye on that specific industrial production group and trying to understand if we're seeing a lot of manufacturing happening in that industry as well. Have to take a break here. There's so much data that has come out this week that, to me, on balance, looks again like an economy that's kind of growing below trend and is in a little bit of a malaise here. It's interesting to see the Fed pick up their growth rate and also pick up their projected rate hikes. The fact that they may increase another 0.5% should give market participants some pause here. So the market, just real quickly turning to how the market's reacting to all this, the market's been reacting very positively to all this, as it's now trading at roughly 4,400. Again, that's kind of breaking out of the channel that I thought we would hold within 4,200 and 3,700, and we would kind of bob and weave in here as we had good data and bad data coming through here. That has now gone through that, and so now you're looking at this and saying, okay, the economy is doing a little bit better. It seems like we're going to quote unquote achieve this soft landing. But something I'm going to keep in the back of your mind that I need you to think about here is the Fed raising interest rates a little bit further tells you the uncertainty that they feel about this environment. They're not sure how the economy is going to continue to evolve post-COVID. And so they're being very cautious, and they're going to remain tunnel visioned on the inflation goal. That means those 0.5% rate hikes, depending on what else comes through the pipeline here, that's additional tightening that I think the market hasn't factored in yet. I think they're still trying to digest that information. And to me, it just feels like that has to keep a lid on the stock market growth until company earnings improve. So once you remove that negative number on company earnings, I think it does have a catalyst to continue to move higher from here. But with more tightening in the pipeline, with negative earnings projected, at least for the next quarter here, to me, it seems like the market has to keep moving sideways for a little bit longer until there's more consensus here. Let's also square this with general sentiment from the AAII. Again, we get this every single Thursday, and you're seeing here that bullish sentiment has really picked up, and it's done it in a matter of just a couple weeks. Remember, 2 weeks ago, we were at 20, I believe it was like 23 or 25% bullishness. Now you're 45% bullishness, and you can definitely see this hooking higher here. Compare that to the bearishness at roughly 23%. That's really come down where it was 60% bearishness just a few weeks ago. The bull-bear ratio is setting at 22% as well. And again, that's looking like it's accelerating and looks really similar, again, to the stock market data that's setting up here at the top. So it's a very interesting environment. The data in and of itself says we are avoiding a recession. That is giving the Fed some pause here, and why the skip in this meeting makes a ton of sense. They want to see more data. They want to see more information before making any decisions here. What that's done is saying, okay, maybe the Fed is done. And so investors have taken that signal to kind of move into the marketplace and go ahead and take advantage of this. And I'm just kind of looking at this and saying, hey, maybe the cautious framework here should make sense. We're still seeing a slowdown in housing. We're still seeing a slowdown in manufacturing, as evident from Philadelphia here. And industrial production came in negative as well. So to me, I think being cautious in the face of this rally makes sense. Maybe use those to reposition. Remember, the rally is not broad-based. it's still in just tech, consumer discretionary, and communications. And there's probably a case to be made to maybe reevaluate some of these beaten down sectors, like the financials, like the healthcare, like the energy. They held up really well through 2020, but they have not been participating in 2023. You'd love to see this broaden out a little bit more, and hopefully that it will. It can't just be three sectors that continue to drive the market higher here and expect this, expect the economy to recover at the same time. And I think the breadth that we're seeing here in sectors underperforming others kind of tells you that there's pockets of strength and pockets of weakness. And I think that's how general market participants are viewing this as well. So again, maybe getting a little long-winded here. What's coming out this week? A lot of housing data. So you're going to get building permits and housing starts. You're going to get existing and new home sale data. So we have been saying that housing's been in a recession. Powell mentioned that there may be a bottoming taking place. I have seen on my estimates for building permits and housing starts that it has been, somewhat bottoming here. Remember, it's mostly in the single family homes. Multifamily units still look to be doing okay, and I'm going to be watching to see if those continue to slow down here. But that's basically the data that's going to be coming out this week. You're going to get another initial unemployment claims report. So it's going to be interesting to see if that continues to stay near or hover greater than 260,000 jobless claims. To me, if you get over 300,000, you definitely have to be worried about a negative payroll report or a much slower payroll report than what we've been seeing. So we'll see as we turn the calendar on June and move into July, whether we see another strong employment report or whether we see some weakness here. So stick with us. A lot of data. I apologize for kind of popping around here, but I tried to give you a general idea of the data that came out this last week, how that's impacted the market, and what that has done to kind of my thoughts. Again, I'm seeing a below trend economic growth environment, a continued slowing of inflation. I don't think the Fed should raise interest rates more. I think they should be done here and allow quantitative tightening to be their form of restriction, at least in the interim. Allow more data to come out, allow the progress that you've already made to take hold, and allow the lagged effects of economic policy to do the work for you. I think that's why the committee wants to skip here. I think that's why the committee is uncertain, because of those three things that Jerome Powell mentioned: speed, level, and duration. I think they got the speed right. I think they have the level right. The duration now is where they need to be focused on and moving to, and just leaving rates restrictive for some time, allowing the economy to grow below trend, and let's bring balance back to what seems to be a shock and not necessarily a recession. I think everybody's looking at COVID and you're seeing ripple effects, and we're just immediately throwing the recession word out there. And we need to look at it as a shock and the aftermath. And, yes, a recession is possible when you're growing below trend. But at this point, I'm changing my viewpoint to say, look, maybe you need another shock, maybe another bank failure, maybe tensions with China heating up, Russia going further in Ukraine. Absence those, I think you just kind of continue to move through this kind of sideways consolidation here in both the market and the economy. So with that, I think that's a great place for us to stop. Stick with us. We'll continue to bring you these weekly updates. If you have any questions at all, don't hesitate to leave me a comment below or shoot me an email. I'll be happy to answer those for you. And if you like these videos, subscribe. Either subscribe to our YouTube channel. The videos go out a little bit later than if you are a subscriber to our research. You can go to myaimresearch.com to subscribe to those. We have different tier versions for different needs that you might have. But they go out first on the website, and they come out a little bit later here on YouTube. But with that, again, I thank you. I hope you have a great week, and we'll be back again next week with another update.